Hello, everyone. This is Tom from MarketsFlow. It is the 26th of July, and we're midway through Friday as we bring you this weekly performance broadcast for the week ending July 26th, 2019. We're back to normal, and I'm joined by Adam. How are you, Adam?
Hi, I'm very well, thanks, Tom.
Well, good to have you back. So let's get started. This is Webcast 13 for MarketsFlow's portfolio performance for week ending the 26th of July. Our podcast is recorded every Friday and it's uploaded immediately on YouTube. Please subscribe to our channel so that you can receive it as soon as possible. MarketsFlow is FCA authorized robo-advisor and digital wealth manager. We're also SEC authorized. Your deposits are protected by the FSCS for up to 85,000. Before we start, I'd like to run through our disclosure. Your capital is at risk and any financial performance figures refer to the past, and that past is not a reliable indicator for the future. With that said, let's cover the important subject. Adam, how have the portfolios been doing this week?
Well, Tom, up to now, and of course we're partway through the Friday session for the market, the high growth portfolio is standing at about plus 0.51%, which taken together with the past means that from the launch of the accessible portfolios, we've now done 3.64. That's effectively from close to the start of June. And in the year to date, 11.45. The growth portfolio in the week so far, 0.39%. 4.16% from the launch of accessible portfolios and 7.75 in the year to date. The ISA portfolio is up 0.43% in the week so far, 2.95% up from the launch of accessible portfolios. And since this didn't exist prior to the launch, we don't have a year-to-date figure for that one.
Thank you, Adam. Okay, and how has that fared with the market as a whole in terms of the performance for this week?
Well, the S&P is up about 1.15% as of right now. Interestingly, that increase this week is almost exactly the same as it declined over last week, leaving it flat over these 2 weeks. But as you know, we don't try to behave exactly like the S&P. Historically, we have tended to be invested around 25 or 30% on average, whereas the S&P, of course, effectively 100%. Therefore, in a week like this one, the neutral expectation might be for us to be up around 0.3. And similarly, last week, you might have expected us to be down 0.3. The fact that we've done better than those expectations is related to the value added coming from things like market timing, stock selection, and all those other techniques we use in terms of portfolio construction, how to implement a position, and risk management. So we don't try to be like the S&P, and we especially don't try to be like the S&P in a down week.
Well, thank you, Adam, for clarifying, and that's very helpful. So what about the allocations within the portfolios for this week?
This week, well, there's been a slight change from recent patterns in terms of what we've seen from our signals. They have been looking slightly downbeat this week, not aggressively bearish, but a little downbeat, in contrast to being modestly upbeat for many of the previous few weeks. So although the market is up, that hasn't come in a straight line, but then the volatility around those index returns hasn't been large. And also implied volatility has not been high, and it's down since last week, as you might expect. Last week, negative week for markets, this week positive. So we'll try to bring all that together. What I suppose I'm trying to say is this: the signals are not enthusiastic about markets. The option premium available, thanks to implied vol, is not generous. So allocation was, I suppose, inevitably quite moderate and not as high as it's been on average for, say, the last 4 or 5 weeks. And the split of allocation between options and stocks has maybe slightly favored direct stock holdings, reflecting that lack of generosity of premium and options.
Thank you, Adam. That does make perfect sense. Well, I guess you can only trade what's available to you. And the other characteristics we've spoken of recently, with top line volatility being very low, with large movements underneath the surface by individual stocks and sectors, does this mean a feature markets now, and how should we behave around that?
Well, yes, that is still very much a feature of markets now. Traditionally known as a stock picker's market, where the big gains or losses arise from picking the right or wrong stocks, rather than from how strongly you're allocated to the overall market. So this sort of characteristic remains in place still, as it has done for some time, and as we pass through earnings season, it's been staying intact. I guess perhaps even supported by earnings season, in the sense that since the earnings season isn't turning out to be stellar, nor is it catastrophic on aggregate, but companies individually are reporting differently from one another, and a few upside and downside surprises here and there. I suppose that's in a way that's a mirror of that stable aggregate with a lot of moving parts underneath. As for how we act, well, we don't suddenly try to change our process for a market that's behaving in a particular way. We have tried and tested processes, back-tested processes, in fact, that are flexible enough to allow for these different types of market regime. So we don't suddenly shift our emphasis and say, okay, well, now we're going to be pure stock pickers in a market like this. I mean, we're going to continue operating the different elements of our process, including varying our allocation through time to the overall market as a whole, and keep running portfolio construction and position sizing and so on along the same lines that we always do, because we know from experience that it imposes a good, effective discipline on the sorts of volatility that we're going to end up producing. It keeps that low and stable. And sure, from time to time, we might make more from options and less from market allocation some periods. But I think what clients care about more is the total result and less about the constituent parts of how we got there. So we really focus on trying to keep those totals good from week to week, month to month.
Well said. Thank you, Adam. How did we risk manage our way through this particular week's market developments?
Well, it's a time of earnings announcements, and that first of all narrows the potential field of stocks we can invest in slightly, because we won't touch anything that's actually currently releasing results. But given our signals, we were naturally, I think, going to be less invested than we might otherwise have been. And at the sector and stock level, as we've said, with this market characteristic, there was quite a lot of action reflecting that dispersion. And investors might be tempted to try and participate in some of that lively market price action, but we don't. So what we've been doing this week, as usual, trying to identify the best opportunities open to us, which were fewer this week than they've typically been in recent weeks, but then manage those opportunities in a careful way and not be afraid to close them when they've generated an appropriate amount of reward.
Makes sense. So how are we set up for today, and how are things looking so far and going into the next week?
Well, it's a positive day for the market in general so far, and also it is for our portfolios. We are relatively light. We're little invested as we come up to the close of the week. So I guess we carry plenty of liquidity into Monday and start from a more or less blank sheet of paper.
Thank you, Adam. That has become our standard sort of practice, isn't it? More liquidity and being light as we go into the next week, sort of going through the weekend as well. And as we proceed through the remainder of the earnings season, do you think there'll be a focus back into the macro news? The talk of rate cuts and growth slowdown seems to be getting louder rather than quieter.
Yes, it may well do as the earnings news flow starts to peter out, and attention may go back to that. The investing public will always be interested in the narratives of macroeconomics, interest rates, politics, and so on. And it's nice to be able to weave that into an explanation of why stock markets behave the way they do. But actually trying to invest consistently on the basis of that, when actually the linkages between these things are fickle and unpredictable and keep changing, it's a difficult one to work with day to day, especially when you adjust portfolios frequently as we do. I mean, a recession might be a once in 10 years event that's difficult to time precisely, difficult to anticipate accurately. And yet we still need to produce money for clients while we wait for one to come along. So, an overt focus on these issues wouldn't really suit our way of investing very well. But we do need to remain cognizant that these stories and news flow of that kind do help to set up the backdrop and the context to everything else. And, there will be times when markets may have heightened sensitivity to macro news.
That's right, Adam. So being aware but not controlled by the big macro stories is really the theme here at MarketsFlow. We are truly data-driven. So another good week for portfolios, and we'll be back again next Friday with a further broadcast. Please remember to subscribe to our channel and have a great weekend. We look forward to our next week's podcast. Thank you. Bye-bye.